for our C.O.B viewers, it's Maynard, Mike, and Todd Scruggs. We're excited today to talk to Thomas Fox. He's the President and Director of Innovation at Highwood Emissions Management. If you're like us, of course, we're all around these emission discussions. We frequently talk about how it's going to happen, the technologies, the regulations, the potential fees and taxes and all this stuff. And in Thomas, we just found a great friend who can help us walk through all of that in the way that an E&P company would have to think about it, because it's significant in a lot of ways. So let me pause and just thank you, Thomas, for joining. We've had a walkthrough with you a few times as a team, and so we're excited to kind of work with you to share a lot of your information with the broader audience here. So welcome.
Thanks, Maynard. I'm really excited to be here and participate. Well,
you're joining us from Calgary. We'll talk a little bit about the Highwood team that's up there, but it's kind of fun to have you patch it in from the Great White North.
Yeah, it's a beautiful sunny day in Calgary. I've been planting tomatoes earlier today, and it's not the winter wonderland it normally is that people think of.
Fantastic. All right, Mike and Todd, on this D-Day, June 6th, here we are, 2023. What would you tell us all to get us going?
Yeah, D-Day. 79.
Are you going to talk about the Saudi?
We're going to talk about a bunch
merger?
of things, but yeah, I mean, just 79 years to the day for D-Day. I mean, it seems like it was just yesterday. So we thank all those guys that really, were involved in that. A couple things that we want to discuss that happened last week, and they were really the OPEC meeting and the debt ceiling deal that occurred last week. And, our first observation on crude oil, obviously the OPEC meeting going into it, there was a lot of, lot of concerns, a lot of positives as well of what was going to happen there. And obviously Saudi went into that meeting saying the shorts speculators need to watch out because they might do something. And Russia went in there saying, you know what, there's not going to be any production cuts. And so what happened over the weekend? There really wasn't any production cuts except for Saudi Arabia said they're going to take 1 million cuts themselves. And so they're taking a lead to stabilize the market. And so, you would have thought that would have been a net positive, and it was a net positive for the day. And right now, crude oil is like right back down to where we were beforehand. And the question is, why are we down? Why are time spreads not reacting? And the reason why is it's the same old issue that's been out there for the last 4, 5, 6 months. It's all about demand. If you look at supply, since sort of October, November of 2022, OPEC's taken somewhere between 2 and 3 million barrels off the market in cuts, and Saudi's taken, most of those cuts. And still, we haven't seen crude oil go up. Time spreads continue to go sideways. And that just tells you that the market is really, really concerned, not with supply, but demand. If you listen to like industrial calls like Caterpillar and you see what they're saying a lot of the regions around the world look pretty good. The only region that really is not meeting expectation is China. So China demand is just not coming in like people expected. Until that improves, I think you're going to have to see, crude oil is going to go sideways. The other thing I would say is most expectations were we're going to have 1.5 million barrel deficit in the second half of this year. This Saudi cut that begins in July almost guarantees we're going to have something that's going to be really, really negative, in deficit. And so that's just buying them some insurance. So I don't think crude oil has that much downside here, but that was the first event that happened this week. The second event was a debt ceiling deal. Okay, and that was great. Took a lot of risk out of the market, but just like crude oil, these equities have gone sideways as well. I think, people are now looking at what's the next shoot of drop here. And I think, just like crude oil, I think most people are concerned with what second half is going to look like for demand. What are interest rates going to do to the economy? Is there going to be a global recession? And so right now what we're seeing is equity, market is going sideways. One of the things I would point out, though, is that the CBOE volatility index, which we call the VIX, is literally at 14, a reading of 14. The last time we got a reading this low was a month before the pandemic. You don't see the VIX at 14 very often. It's typically around 22 or 23. That's 60% higher. And so all I say is that markets now seem to be assuming very little risk, and so whenever there's, the market's assuming very little risk, something's around the corner. And so the point we would make is a lot of energy companies are buying back stock aggressively because at $70, $75 oil, the intrinsic value of their stocks is really, really attractive. All we say is with VIX this low, I think maybe the prudent thing is maybe to park, aside a little bit more cash on the balance sheet than you might have otherwise, because it might come into good use. And so that's what we say. Those are the two events that really drove the markets. I think we're going to see some implications of that over the next couple of weeks and months.
Hey, Mike, what was with the deal with the Saudis saying, there was a handful of news organizations, they were saying you can't be close to the meeting, you're out, you're shut out. Was there any significance to that, or?
Well, I think with anything, it's, openness is always better. And, some reporters that I had known that had been there in the halls of Vienna, in the stairs of Vienna for the last 15, 20 years were excluded. I think some of those guys were very, very balanced. And so just by not including them, I think it was just a really, really bad look. And so we'll see how that goes going forward. But yeah, really, really, really dumb, on their part, I think.
Interesting. Todd, what do you got?
Well, a couple of things, one macro and one ESG related, and will be along the lines of our discussion today. On the macro front, Goldman came out with a report this morning that lowered their assessment of the odds of a recession, which is good news. And then, they talked about how they are projecting that the Fed might hike. What was interesting is I saw the report on CNBC, and then right after it, they showed markets today and they showed yields for bonds. And the yield curve is still pretty substantially inverted, which kind of got me thinking. So I went to my desk and started looking at stuff. And I think everybody knows these stats, but kind of like Mike was just talking about how the markets are pretty tranquil. The last 10 times we've had a recession, the yield curve has been inverted. And that takes, 12 to 24 months to manifest. Secondly, I read a stat that the S&P 500, the entire gain year to date is explained by something like 7 stocks, and it's names like NVIDIA and people like that. And then lastly, Mike just touched on this, OPEC continues to cut supply, but, it seems like it's really a demand problem. And this last time there was rhetoric around defending the price and defending the barrel. It kind of reminds me of when, countries are defending their sovereign currencies and they're talking about protecting it, and it never seems to work. So I guess what struck me was the juxtaposition of this Goldman report, but then these other signs that may not mean anything, but taken collectively, don't paint the rosiest picture. And Mike and I didn't coordinate that beforehand, but it just kind of came out that way. Secondly, a news item that caught my eye that I think is pretty germane to this topic is Exxon and Chevron both had shareholder meetings recently, and there was a Wall Street Journal article about ESG proposals that were put forth at those shareholder meetings. The one that caught my and I should say, at the beginning, those proposals were all defeated. The one that caught my eye was a proposal that was a multiple year repeat proposal about addressing Scope 3 emissions. And this year, the percentage that passed dropped. Last year, those were around 25%. This year, it dropped to something like 10%. So I don't really know what that means if there's a longer term trend, but I do think it's interesting that these big energy companies, while still, facing some scrutiny and pressure, maybe some of that is relenting just a little bit. And so I think that'll be something worth watching from here on. So with that, Maynard,
awesome.
Let's kick it off.
Yeah, really interesting, guys. Thanks. Well, Thomas, again, welcome. We're delighted to have you. I didn't do your introduction, justice, because I should have mentioned you've got a Ph.D. from the University of Calgary in smart emissions sensing technologies. You were part of a team that led the development of a software that's an open source software that helps you simulate methane and leak detection technology. So you've really been around the space, not just in a commercial way, but in a scientific way. So we're delighted to have you and get you to shed some light on the thing that is talked about so much, which is emissions monitoring and where we're going with all of our thinking. But so glad to have you.
Yeah, thanks so much, Maynard. Emissions is certainly a hot topic these days. So I like to think that I got lucky to be so popular at this time. But yeah, I've been in the space for about 7 or 8 years now through school and now in a commercial capacity, working with oil and gas companies of all shapes and sizes. And different parts of the world to try and get a handle on this kind of emerging and rapidly evolving topic that's got a lot of folks confused, interested, curious, scared in some cases.
Maybe one place to start, Thomas, is, we'd had the good fortune of meeting you and get to know you a little bit. And then it was fun getting to know MiQ and their approach to, certified natural gas, so that we can, as consumers, we can know that we're getting the gas that was produced under the best possible methods. Do you want to talk about that relationship with MiQ and kind of how Highwood fits in with them?
Yeah, for sure. So we have a strong relationship with MiQ. We really respect the work that they're doing. They're really pushing this idea that if we have a better understanding of the carbon intensity or the environmental impact of the commodities that we consume, then buyers can make better decisions around what commodities to purchase and be able to better explain what their emissions footprints are as buyers of that commodity. So we've been working with MiQ for a couple of years. I should say that there's quite a number of emerging standards, and we work with a number of them that are trying to provide the ability to certify natural gas or provide companies with frameworks for how to quantify and report their emissions. As an advisor of oil and gas companies, we do consider ourselves to be independent of whether it's a certification or a specific type of technology, whether it's for monitoring emissions or reducing them. But MiQ is certainly becoming popular, and I think they now certify over 20% of the natural gas that's produced in the United States as a low methane product.
Well, you touched on another thing, which is an interesting feature of this landscape, which we've talked about here as we meet companies that have various technologies for monitoring emissions, is that there are quite a number of ways to do it. There's quite a number of companies doing it. There's different methods. There's ways to integrate them, and then of course there's a regulatory and financial community that's looking for data that they can rely on, and so on and so forth. So it's kind of it's like a concept that everybody embraces. Like, this is great, we should have minimal emissions, but then the practicality of doing it, it's pretty complicated as to how it's going to sort out. And as you said, you're technology agnostic.
Yeah, we're certainly in the messy middle of figuring out how to use these emerging methane detection and quantification technologies. We at Highwood, we have a database of 200 commercially available solutions, and they all differ. They range from really close range handheld systems to satellites that are kilometers away, to everything in between, including continuous monitoring. And they provide very, very different information products. And we're kind of in the middle of a paradigm shift too, where in the past, operators were really focused on detecting emissions, so that, especially leaks, so that those leaks could be repaired and we could get on with our lives. But due to different kinds of pressures from investors, pressures from regulators, we're now seeing a trend in which operators are being asked to quantify their emissions, not just detect leaks, but say how much their emissions are. But most of the technologies that we use provide incomplete information. So either they only detect above a certain threshold of sensitivity, or they only provide a snapshot measurement that might be representative for a short period of time. And so there's this emerging challenge of taking those bits and pieces of information from different technologies at different pieces of time and stitching it together into an overall estimate of what a company's emissions are over, for example, an entire year, so that a certification or a body like MiQ can say with confidence, based on measurements for this specific company, your methane intensity or your emissions normalized by your production are X.
Well, I know you have some slides you were going to take us through, and then, Mike and Todd and I, periodically we might jump in as you're on a certain slide with a certain question, but I think you doing your walkthrough would be good for all of us.
I'll just jump into it then. I like to structure this presentation by talking a little bit about the motivations for why companies are thinking about emissions so much more today than they have been in the past, and then helping kind of understand the complexity of the challenge. So understanding why this isn't something that we can just go out and measure and get the answer, and why there's so many different technologies and methodologies and paradigms around how to do this. And then get into, well, once you have the data, how do you actually reduce your emissions? It's not as straightforward. There's dozens of potential sources of emissions that you could spend money to abate. Which ones do you choose? How do you take that dollar and make it go further in terms of achieving your emissions reduction targets? Once you've spent the money on reducing your emissions, and how do you actually prove it and start to take credit? There's emerging regulatory and voluntary initiatives that are available for companies who want to show the world and in some cases monetize their emissions reductions. And then the big question that everyone's really excited about is how do we actually prepare for the future? What's coming? We all are. I think we're all aware that this landscape is evolving quite rapidly. Is it going to continue to evolve, and where is it going to go? So the first thing I want to talk about are some of the drivers of why we're seeing oil and gas companies start to be really interested in this decarbonization challenge. One of those is the growing availability of public data, specifically methane data. And this data, as we'll talk about in a minute, is pretty opposed and pretty inconsistent with what we thought emissions were, based on the types of emissions that are, and the amounts of emissions that are reported to the regulators, such as EPA. And we're starting to see news articles, often they're in Bloomberg, of giant methane plumes that are detected from space and that are in some cases unreported or unexplained, and that have very large impact, for example, for climate and ground level ozone formation, but are also of interest to investors who, for them, this is a lost product in some cases. And these events are not one-off. So what we're starting to see is that there are a large number of publicly available data sets that are emerging. And many of these will tell you, pretty much exactly what company is emitting, how much they're emitting. And I like to do the conversion from kilograms per hour, which is kind of hard to contextualize into dollars. So if this one source that I chose from this publicly available data set were converted at $3 in MMBTU to the entire year, this would be over $1 million in lost revenue from this single source. And so this is really an important consideration from a product loss perspective, as well as a PR perspective, because the companies who are having to explain these large plumes that are entering these public data sets are having trouble doing so. The other driver, obviously, is regulations. We've had regulations for quite some time in Canada targeting methane. These regulations in Canada are about to get more stringent with a 75% emissions reduction target for the oil and gas industry. We're also seeing stringent regulations appearing in the US. The EPA has just finished its second round of commenting for what's known as Quad O-B and Quad O-C. And so this is really a game changer in terms of how stringent the methane rules are going to be, not only for new sources, but existing sources as well. And if we just look at some of the big changes that we're seeing in upcoming regulations, we're seeing the prohibition of routine flaring of associated gas, which we didn't see before. We're seeing that gas-driven pneumatic controllers and pumps are no longer going to be allowed in both Canada and in the US. And then we're seeing the emergence of some really novel and interesting regulatory drivers. One in the US is called the Super Emitter Response Program. And this is a new program where public organizations, and so these will include, for example, the EDF, who are currently building a methane satellite funded by, in part, Jeff Bezos, are going to be able to submit any plumes that they detect or any emissions events that they detect to the EPA into a publicly visible database. And oil and gas companies are going to have to respond to that and say what happened and how the source was resolved. And so this is anticipated to create a very different set of drivers and is maybe a concern for some companies who are routinely emitting above this threshold of 100 kilograms per hour. The other big one that everyone is talking about right now is the methane fee. I kind of saved the best for last year. And so starting in 2024, the EPA is going to be, with the IRA bill, the EPA's calculations are going to be used to estimate how much of a methane fee or a methane tax that companies are going to pay if they're emitting above a methane intensity of 0.2%. Methane intensity is really just your methane emissions divided by your production. Then for anything above that threshold, companies will be paying $900 a ton in 2024, stepping up to $1,200 a ton in 2025 and $1,500 a ton in 2026. The big difference is that in 2026, we're moving from EPA calculations, which are known to be underestimates of actual emissions, into some kind of yet to be defined empirical framework, which will leverage measurements to estimate actual emissions that taxes have to be paid on. And so we've done an internal analysis at Highwood to try and determine, how many companies are going to be paying the methane fee, how much they are likely to be paying under different situations. And the graph that you see on the left here, this forecast for the next 3 years is assuming only the EPA calculations are going to be used. And under those assumptions, we estimate that approximately 200 companies will be paying. This is assuming that 2021 data holds true and that no companies respond. We know that a number of our clients and companies are actually reducing their emissions actively right now in order to avoid this fee when it comes. The exciting part here, or the interesting and potentially scary part, is that if we move to an empirical basis, where the fee is calculated based on actual measurements rather than simply engineering equations, then the potential for how much a company could pay could increase significantly, because based on most studies that we've seen to date, there's about a 6 to 10-fold increase when you move from the EPA calculation methodology to an actual measurement informed inventory. And so under those conditions, we estimate at Highwood that the total expenditures of the oil and gas industry could be in the order of $6 billion by 2026. The next piece here is just about kind of understanding why it's so hard to know what your actual emissions are and why efforts like this methane fee are going to be extremely controversial and difficult to enforce. So one of the first meta-analyses that came out on methane emissions was in 2016 by Adam Brandt's group at Stanford University. And they looked at about 15,000 source level or component scale measurements of pneumatic instruments and flanges and valves from about 18 different studies. And they found that about 50% of emissions come from around 5% of sources. And the reason I call this an opportunity is because if you want to reduce your emissions by 50%, then you really only need to identify this 5% of sources. And so we call these the low-hanging fruit of methane emission sources. And the really interesting thing here is that it doesn't really matter whether you're looking at a company scale or whether you're looking at an equipment scale or you're comparing different types of equipment or different types of sites. This general rule of thumb holds true in that a small number of sources account for the majority of emissions. And recently we've moved, this is an older study from 2016, we've moved from source level or component scale measurements into site level measurements with aircraft. And the exact same rule holds true. In fact, when you look at site level measurements and you have a much larger sample size, the distribution is even more skewed. And so something like 80% of emissions come from about 2% of sources. And so in the largest ever kind of published measurement campaign in history, which is of the New Mexico Permian Basin, was around 100,000 aerial well site visits. And this is a collaboration between Stanford University and Kairos Aerospace. They found that there's about a 6.5 times or difference between what companies report that they emit to the EPA, so this is what they would be paying their methane fee on, and what they actually emit based on these measurements. And this is the type of measurement methodology that would be used potentially to calculate the methane fee. And so this is a huge amount of uncertainty if you're trying to calculate as a company how much money you're going to be spending in this methane fee and trying to manage how to reduce your emissions in order to avoid it or get below the threshold at which you would pay. The other piece of this is that most of these emissions that were detected are quite large. Kairos in this study was detecting emissions at between 1% and 3% of sites, and so all of those are really large sources. But if you add all of those up, it actually accounted for about 9.5% of total methane or natural gas production in the New Mexico Permian Basin over the time period of the analysis, which is not only inconsistent with the 0.2% threshold that the government is looking to achieve, but also very concerning from a product loss perspective, because the value of this gas is significant. That's why there's a huge number of technologies that are emerging, and we do a lot of this space. My background is, as you know, Maynard, is really in understanding these technologies and evaluating how they work so that we can be collecting the right data and making the right decisions about how we decarbonize our energy system. So we have a database of about 200 commercially available solutions that exist right now. A large number of those are actually stationary or continuous monitoring systems that are kind of measuring at all hours of the day to determine if anything, any kind of unexpected methane emission sources arise. But you have all kinds of different solutions that are emerging, from satellites to aircraft to handheld systems, drones, and vehicles. And a recent article by Bloomberg has actually pegged the size of this market at almost $1 billion globally by 2025, with about a quarter of that, about $244 million for satellites. And so this is a really large emerging market, and part of what's driving this is the fact that we really do need to have a better understanding of what our emissions are, so that we can make more intelligent decisions about how we reduce those emissions and how we develop sensible policy that helps operators actually drive their emissions down, and prove to buyers, prove to investors that they've done so. I like to show this slide because it gives kind of the perspective of the huge diversity, both spatial and temporal variability in what different technologies provide in terms of information products or data products from methane measurement campaigns. And so just a couple of examples to point out here. In the top left, you see an image with the scale bar there of about 30 centimeters of an optical gas imaging camera that's commonly used by technicians to perform leak detection and repair surveys. In the bottom right, you have a satellite image from space of a massive methane plume being emitted from a dam in Cameroon. And then everything in between. The bottom middle image is an image by Kairos Aerospace, the same data provider that participated in the study that I was talking about in the previous slide, of a large plume that's coming off of it looks like a battery in the New Mexico Permian Basin. So one of the things that one of the questions that we often get asked is, if there's all these technologies available, how do we actually select technologies for deployment? How do we navigate these trade-offs of sensitivity and cost and performance, so that we can, as a company, can actually achieve our emissions reduction targets and understand how much it's going to cost to get there? And not only that, but how can we do that while complying with not only regulations, but an emerging variety of voluntary initiatives, gas certification schemes, international reporting requirements, and so on and so forth, that are beginning to require the use of different types of technologies, specifically a combination of bottom-up inventories where we use those engineering calculations and top-down measurements that independently evaluate whether those bottom-up estimates are accurate. And this is kind of the emergence of what we call within methane reconciliation. And so because it's so hard to actually peg down with any one method what your emissions actually are, we're starting to see standards and regulations require the use of multiple different methods, and then either bringing those methods together into a kind of a more robust estimate, or performing some kind of comparison between the estimates in order to improve one of them. So the leak detection and repair simulator is the open source software, Maynard, that you referred to in your introduction that I started building during my PhD, but we've been building for quite some time now. That's used by companies to help them determine what technologies to deploy so that they can forecast into the future. What will my emissions be under different technology deployment assumptions, under different survey frequencies, under different sensitivities? How much is it going to cost to achieve my emissions reduction targets? We actually offer a whole bunch of training in LDAR-Sim, and we like to keep this open and available because it's used by regulators to approve the use of new technologies by oil and gas companies who want to do things differently. And so we have, because this model is completely open source and can be used by anyone, we offer training in how to use that system, as well as kind of broader training around what technologies exist and how to think through using them. The third piece I'm going to talk about is how, once you've actually deployed some technology and started to understand your emissions, how do you actually make a dent in those emissions and start to reduce them? And so one of the tools that we use is called reduction pathways. And I like to call reduction pathways our net zero pathway planning tool or emissions reduction road mapping tool. And what companies really want to be able to do when they're thinking through, do I set a net zero target? Do I set an intensity-based target? Do I sign up for the OGCI is aiming for zero initiative? Do I just do 50%, or how much is it going to cost to achieve regulatory compliance under the new EPA rules? They want to compare different scenarios for what technologies to deploy to reduce known sources of emissions. So a lot of methane comes from, for example, gas-driven pneumatics or open air tanks, or incomplete combustion on compressor engines, and other intentional or known sources of methane. So how do we actually deploy technology to reduce those known sources of methane? And in order to build out those scenarios, you actually need to understand what your inventory is. You need to understand what equipment you have, how that equipment works, how often it operates, the make and model, and so on and so forth. And when you have that bottom-up inventory and that configuration, then you can actually layer on all of the potential projects that you could potentially do at every individual site to reduce emissions. And you can build out a company-specific marginal abatement cost curve that shows you on $1 per ton of CO2 equivalent emissions reductions what the lowest hanging fruit are. So if you're actually aiming for a specific target, how do you spend as little as possible in order to get to that target? And the answer is actually very different for different companies that you talk to. Of course, that bottom-up inventory, that knowledge of what equipment you have and your sources is really critical in order to get there.
Thomas, could I ask you, if I'm a typical lower 48 producer, and I know there's probably no such thing, but if I'm a typical onshore producer of some size and I was getting exposed to all this, is there a way for me to kind of quickly say, this is going to cost about X cents per M of my production, or this is going to increase the cost of my product by 10%? Or is there a range you give people when they say, okay, plus or minus, if I do everything here, what might it cost me? Is there a way to think about that? Or even from a consumer standpoint, what is this going to do to the cost of the product?
Yeah, that's a really good point. So we haven't normalized the cost of some of these emissions mitigation strategies to production yet, but many of it really depends on the time scale that you're looking at and what kind of mitigation or emission source level data that you're using in order to do those calculations. And many of the projects that we propose over a 5 or an 8 year time horizon actually are a negative cost if you account for, in Canada, avoided carbon tax, in the US, avoided methane fee. and the value of the product that's conserved. So in some cases, it could make the product even more cost effective, but it really depends because it gets complicated with the opportunity cost. You're spending money on emissions reductions instead of potentially drilling another well, for example. So it's a bit of a complex calculus there, but it really depends on whether you're looking at things from EPA calculation methodology, what projects you would do, and whether those projects would be cost effective or not, or whether you're leveraging your measurement data in order to inform what emissions reduction projects you do. I know I kind of dodged the question there. There's
Nope.
Yeah.
Nope. It's hard to simplify, but that was helpful.
Yeah. So we actually, and to put a couple of dollar figures to this, not in the metric you asked for, Maynard, but we actually did a Canada-wide analysis, and this is something that we would love to do for the U.S. as well with the new EPA regulations. But Canada recently set a target to achieve a 75% emissions reductions of methane from the oil and gas industry. And so we went about and said, okay, well, let's apply this simulation tool to all of the sites that would be regulated in the Western Canadian Sedimentary Basin, which in this case is close to 32,000 sites in British Columbia, Alberta, and Saskatchewan. And then we'll apply this analysis where we look at exactly what equipment is on each of these sites, and then we apply the most cost-effective projects to those sites in sequence in order to, until you hit that 75% emissions reduction target. And what we found in this analysis, and there's a lot of assumptions in here because there's a lot of data that we don't have for individual companies. But what we found is that it's going to cost about $2.2 billion in Western Canada to achieve the 75% methane reduction target. Obviously, there are diminishing returns on spending money and achieving emissions reductions when you're using a marginal abatement cost curve. And the further along the cost curve you go, the more and more expensive the projects get on a dollar per ton CO2e basis. And so if you wanted to go all the way to kind of full electrification, and achieving net zero without purchasing offsets, we're in the tens of billions of dollars of estimates. So you can get most of the way there with a $2 billion investment, but the last 25% will be extremely expensive to achieve. And we find this kind of across the board, both for individual companies as well as at scale. The second analysis that we recently performed that I just wanted to mention quickly is more on the fugitive emissions side. And this is one that we're going to be presenting at World Petroleum Congress in September that we're really excited about. This is the kind of the first light of day this analysis has seen, so we're pretty excited to showcase it here. But what we've done is we've used different leak size distributions. So what we've found is that based on where you're performing your data collection surveys, and these are kind of academic peer-reviewed studies, you have different leak size profiles. So in some regions and for some companies, you find mostly small leaks. In other cases or with other technologies, you find quite large leaks. And depending on what leaks you find, that can have pretty important implications for what technologies you deploy and how much it's going to cost to actually achieve your emissions reduction targets. And so we've tested this out with 3 different leak size distributions, which are plotted on the left. And on the plot on the right, you can see that the amount of mitigation, which is the difference between the gray bar and the other bars, which represent the different technology classes, really depends on how big the leaks are that you would expect in a system. So if you're expecting larger leaks, your LDAR program is likely to yield greater mitigation. And this is important when you're comparing the value of an LDAR program relative to the value of implementing other types of emissions reduction projects or technologies that reduce known types of emissions, which are the ones that are typically plotted on a marginal abatement cost curve. So on this plot, you see that we're comparing different types of projects on the x-axis on the basis of on the y-axis on the basis of dollars per ton CO2e, which is kind of the general apples to apples metric for comparing the value of an emissions reduction project. And then you can see that the purple bars are these kind of typical, some of the typical, we have a database of almost 100 of these, but some of the typical categories of projects. So improved, engine efficiency, replacing low bleed pneumatics replacing high bleed pneumatics with low bleed pneumatics, and so on and so forth. And you can see that the colorful bars are the LDAR programs with the different emissions distributions. And you can see that when you have a typical emissions distribution or a company, for example, with small leaks, the value of implementing or improving an LDAR program is quite low. But when you have one with large leaks, the value increases and the price of reducing those emissions drops significantly. And so when you start to think about what your emissions reduction strategy is and where to spend those valuable dollars on actually achieving your targets, you really have to understand the context of what emission sources you have and how big those sources are. The next piece, which everyone wants to know about, is taking credit. So, how do you take credit once you've actually achieved your emissions reductions? This is something that we have a lot of conversations with oil and gas companies about as they start hearing about and thinking about natural gas certification. And in fact, a couple of years ago, we were also confused about this kind of emerging variety of voluntary initiatives that existed for oil and gas companies to go kind of above and beyond to demonstrate their emissions reduction performance. And so we put together a report first in 2021 and again in 2022 that's freely available on our website. You can go and download it today on the kind of diversity of voluntary emissions reduction initiatives, where they fit, what they can do for operators, and more importantly, how difficult or taxing they are to participate in. And so we're currently working on version 3 of this, and version 3, I promise, is going to be the best one yet. And we're planning to come out with that one in August. One of the big ones that I'll touch on, and I can't really get into the details of this report here, but is OGMP 2.0. We're hearing a lot of talk about the United Nations Environment Program's Oil and Gas Methane Partnership. And what this is a global reporting framework with over 100 signatories from around the world. It's consensus-based, and what it does is it requires companies to set a target. It's forward-looking, it's a commitment, and then report on progress towards achieving that target or those targets, whether absolute or intensity-based, over a number of years. And what makes OGMP 2.0 significant is that it has a ton of traction, for one, but for two, it actually requires measurement. And so it's not like kind of traditional calculation methodologies. It actually requires company-specific measurements to be performed on representative samples and company-specific emissions factors to be derived so that the reported methane emissions are actually tied to the actual emissions of that company rather than based on kind of general industry average estimates. The other one that we're hearing a lot about now is MIQ. MIQ is different than OGMP in that whereas OGMP is looking forward and a commitment and building towards something and continuous improvement, MIQ is almost an award for what you've already accomplished. So you, as a producer, you can apply to become certified. It's independently auditable by third parties. And currently about 20% or more of gas in the United States that's produced is certified by MIQ, and that number is growing rapidly. Just a couple of years ago, it was 0. And so we've seen a huge amount of growth in this area. And the certificate is based on a number of different things. One of them is methane intensity. And so a company has to calculate and report their intensity and has to get it below a certain threshold in order to be certified. And MIQ has just updated their protocols so that intensity now has to be informed by actual measurements, not just bottom-up calculations. One of the things I'm really excited to announce as well, and this is, we're looking to have a press release on this on Thursday or potentially early next week, is a new index that we've been working on alongside MIQ The reason that we've been building this index for the US is that buyers of certified gas, whether it's large industrial entities or individual consumers, if you buy a product that is certified to, for example, a 0.05% methane intensity, which is what MiQ A grade is, it's really hard to say what that actually means, especially if you have an emissions reduction target, unless you can compare it to something. And so up until now, there hasn't been a robust measurement-informed index of what the average molecule of natural gas in the US, what the methane intensity of that molecule was until this. And so we're really excited to be launching this. We think it's going to be a game changer in basically providing organizations who are purchasing natural gas the ability to say with confidence what their own carbon footprint is by consuming that product. And we really think that this will be a boon for the natural gas industry and for suppliers of low carbon sustainable natural gas. A couple of slides here on the future. I know everyone wants to read the tea leaves. So when we look at what's happened over the last 5 years or so, we're seeing a really dramatic transition in emissions management, where we're moving from simple data sets and spreadsheets and simple calculations to billions of data points. We're seeing methane and emissions data in general coming in and needing to be managed from many different technologies, many different quantification algorithms and methodologies, and having to be managed and interpreted and used in much more complex ways. We're seeing the emergence of public data, the emergence of dozens, if not hundreds, of new alternative technologies for both detecting and quantifying methane emissions, but also for reducing those emissions once you've found them. And then, of course, all of these new initiatives and the regulations, which on their own are a big enough headache for a lot of companies. And so when we think about what to expect in this landscape, the big ones are kind of this move towards carbon accounting. And as you indicated, Maynard, this is a big question mark in terms of how do you actually do this. And this is something that a lot of organizations are still working on. Reconciliation will likely be a big part of this. So, integrating diverse data sets into more robust or more accurate estimates of what actual emissions are. But there's going to be big challenges in the coming years around quantifying uncertainty, especially with some of these emerging methane detection and quantification systems, and also bringing everybody along. And I expect this will be something that we talk about a little bit. But the IOCs are investing tons and tons of money into this, and they're making really good progress in terms of reducing their emissions. But it's really a complex challenge, and there is still everyone else, all the other oil and gas companies who need to think about how they're going to participate in this and consider how to spend money sensibly on reducing their emissions and being able to demonstrate that they've done so. Veritas is kind of the last thing I'll talk about today. This is a new initiative by GTI Energy, which is enabling companies to leverage measurement to actually prove out what their emissions are. And so this is something that could be used and is likely to be used by regulators, by OGMP, by groups like MiQ, anyone who wants a company to demonstrate their intensity, their methane intensity, using measurement-informed inventory. And so Highwood's really excited about this effort. We've been involved since the inception of Veritas, and it's starting to get quite a bit of traction. So stay tuned. This methodology could become more prominent and could enable operators to leverage the data they're already collecting in order to demonstrate their emissions. So with that, just a couple of key takeaways from this talk. One is that it's really hard to actually put your finger on what your emissions are, and this is kind of an opportunity for continual improvement. But measurement is kind of the key to getting a better sense of what your emissions are, and we're seeing that most of the emerging standards that are coming have requirements for data that is better than what we're currently able to provide. So that's why these technologies are rapidly innovating. That's why we're seeing efforts like Veritas and MIQ and OGMP emerge that are requiring measurement-informed inventories. There is an opportunity in change, especially when you look at potential exposure to new regulations and in particular the methane fee. There's a lot of money that could be saved by acting earlier and preventatively on some of these issues. Small plug for Highwood, we've been building software and tools, and we also do lots of consulting in this area to help companies better understand this landscape and make sense of things so that they can make better decisions. So I'll stop there, and Maynard, I'll give it back to you.
I'm going to give Mr. Bradley, defer to Senator Bradley for the first question.
There we go. Yeah, it was really interesting to me that that one stat that companies emit 6.5 times more than they think they do. And I'm sure that's a range of some companies, maybe it's 20 times what they think, and sometimes it's probably twice what they think. And I guess my question is, and Maynard kind of sparred this question a little bit. He talked about how much on a per MCF basis is this going to cost? I mean, you said something to the effect that it might be negative, and that means that other people are much higher than they are, so they're going to be able to come underneath them. And so one of the big themes that we've been talking about probably over the next 4 or 5 years is this consolidation theme, and that's upstream, downstream, midstream. And I guess my question is, given the 6.5 times more than you emit, how much is the emissions going into, hey, this is what we're looking at paying for your company? Are people starting to ask that question today? Is it going to be a bigger factor, especially in 2026 when these methane fees start to go into effect? I mean, are we starting to see that right now at all?
We are starting to see that. One of the things I didn't mention in my talk is that we also work with private equity firms, and we see about as much diversity among private equity in terms of what's motivating them as we do within individual oil and gas companies. But there are PE firms now that have net zero funds that are specifically focused on the oil and gas industry, and they're very interested in understanding, what a company's exposure is, not only to the new regulations, which are going to cost a lot of money to comply with, but also to the methane fee and also just to kind of the lost products. So we've started to have more and more conversations with companies who are, relatively small at step 0 of emissions management, and in some cases, not even thinking about the regulations, but thinking about being acquired, and thinking about being acquired by larger companies who are supplying LNG exports, who are already certified, and those certification requirements include the need for all of your assets to be certified. So if you do an acquisition, it makes it a lot easier if the company that you're acquiring is also certified. And some of these smaller companies are approaching us and saying, hey, we want to get certified because our kind of corporate plan is to be acquired in the next 2 to 3 years.
And so also when you look at that sort of emission intensity, is it the same in upstream, downstream, midstream, and which is more intense? I mean, where's the range, wider or tighter across those 3 different industries?
Yeah, intensity is highest, typically highest in production, and then in midstream. It varies a lot by basin. It almost varies more by basin than it does by supply chain segment. And there's also different ways of calculating intensity. And so it could be simply on kind of a loss rate of gas produced. But if you're looking at a region that is also producing natural gas liquids and oil, that's not really a fair comparison because you're losing methane, and the denominator now is not energy, but simply natural gas. And so we do see quite a bit of variability between basins on that intensity number. And it's also changing quite quickly through time. A lot of companies are really driving down their intensity, at least on paper. And this is one of the reasons that measurement is kind of throwing a wrench in things. And we've seen this in Canada as well. We're developing policy. Regulators are developing policy based on their best understanding of where emissions are coming from. But those kind of older estimates, the bottom-up inventories, are not consistent with the new measurements that we're performing. So the policy they developed is not actually effective in reducing emissions, which is incredibly frustrating if you're spending money on reducing your emissions to achieve those policies, right? So,
hey, Thomas, really interesting stuff. I noticed on one of the graphs you showed, you were talking about sort of, you had bars that were going over the marginal cost to abate emissions. And one of the things that struck me on the graph is that, the y-axis was actually exponential and not linear. So you get all the way to the end and you've got these extremely high costs to abate. If a company was willing to purchase offsets, where do you think that breakover point is, where you kind of move from, I've got the low-hanging fruit, I've done whatever, 75, 80% of the mitigation I can do, and now I'm starting to hit that exponential cost. Like, as you've worked with companies, is there a point where you say, okay, once you hit about here, you really ought to think about some kind of market-based solution?
Yeah, we leave that decision to the company, but it's a very common analysis that we do where we will rank order the opportunities by cost of mitigation, and then tell companies, well, once you get to this point, and and as an anecdote, that could be 80% of emission. If you spend up to $500 a ton, that'll get you to 80 or 90% of emissions. Is kind of ballpark what we see. And then you're right, it gets exponential because you're building in power lines in order to get to a remote kind of compressor station in order to electrify a compressor station or something. And it's just a completely outrageous expense that is going to achieve a relatively small emission reduction. So there is no clear-cut answer there, and the market-based solutions are evolving rapidly as well. But I think that if you, as a company, if you want to achieve net zero, for example, and you want to do it purely by reducing your Scope 1 emissions and not buying offsets, it's going to be extremely expensive. And most companies talk about going 80 to 90% of the way there before moving to a market-based solution.
You said you're tracking something like 200 different companies, technologies, whatever. Are there new technologies that are showing up that you guys are excited about that you think might help cut into some of those last tons costs, or maybe that just make the first tons way cheaper to remediate?
Yeah, I mean, I can't name names because we can't be seen to pick favorites. But the innovation landscape right now is really interesting. On the measurement side, it's extremely competitive, and so we see a lot of inflated claims and misinformation that is, not completely nefarious, but is, data that's massaged in order to make a certain company look better or worse. And then on the abatement side, there's really no way of getting around what some of these solutions cost to, for example, electrify, right? And the high cost of mitigation that you see at the tail end of those MAC curves is not typically because the technology is super expensive. It's because the emissions that are left to abate are very, very small, right? And it's almost not worth, completely changing out a piece of equipment if it's only going to reduce your emissions by a ton per year, for example, or the equivalent of one car on the road or something. So right now, we spend a lot of time kind of sifting through the weeds and trying to figure out, separate hype from reality. And the innovation, the acceleration of innovation is very healthy at this time. And so I think we're going to continue to see lots of changes and probably some disruptions over the coming years.
So one thing you were talking about, Thomas, in the upfront is, so right now in the IRA, the fee is proposed as $900 a ton. And in 2026, it's going to go to measurement based, and it's going to be $1,500 a ton. Is there, and I think what Mike was pointing out with the 6 times slide is that, right now we don't have full faith in measurement yet because we haven't really figured out the best way to do it. Is there a chance between now and 2026 that the industry comes up with its own, like, this is what we think is the right standardized technology approach, and that intervenes and becomes a sort of a different standard? Because it seems like this is all good news. We should measure this stuff, There's great ways to catch it. It's going to be good for natural gas, and natural gas is a great fuel for accomplishing a lot. But the bad news is we have a lot of measurements that are not in sync, and we could overestimate what's going on here. So is there a chance for industry to step forward and improve some of this? What do you think?
To be honest, I think that having worked on this problem and knowing how difficult it is, I think that if the regulator were to try to propose something in a vacuum, that it would not work at all. This is going to take, building out these standards for such diverse technologies that perform so differently and have such high uncertainties is going to take a lot of work. And so this is what Veritas is. So Veritas is intending to be the methodology for estimating intensity using a measurement-informed inventory, and it's driven by industry. So Veritas has over 40 sponsors from all across the supply chain, including LNG, transmission and storage, distribution, gathering and boosting production, and transmission. Most of the biggest companies in the US are participating in some capacity. Exxon and Chevron and EQT and Williams and so on and so forth are all sponsoring this effort because, for one, they recognize that these regulations are likely coming where they're going to have to demonstrate their emissions using a measurement-informed inventory. And for two, they've made commitments to actually reduce their emissions. And they can't really demonstrate that they've achieved emissions reductions using a calculation methodology that's not representative of their actual emissions. So if they're going to be spending money on actually reducing their emissions, they want to be able to take credit for those reductions using a company-specific measurement-informed approach. So that isn't to say that Veritas is perfect or finished, but I think that it is the industry proposed solution that will be used, and we've already seen indications that the Colorado Department of Public Health and Environment, who is implementing an intensity-based regulation, and they've indicated that they may use Veritas as a methodology for companies to demonstrate their intensity.
So maybe as we move towards wrapping up, one last question. I think one of the things we always talk about, kind of from an energy standpoint, is that U.S. production methods, U.S. and Canadian production methods, generally speaking, are cleaner, lower impact, better than they are in the quote rest of the world. Do you have a feel for that? Can you give our audience a sense of quote how true that is, or just any light you'd shed on that? Because I think that's kind of a central belief that we all have, but I don't think it's not easy to quantify.
No, I would agree with you in principle, and we've been having these meetings and conferences for 8 years, and since I've started working on this at the beginning of my Ph.D. in Canada, and I always say that we often get up and say, we're the best in the world, we're doing great, and we know it to be true, but we haven't had the capacity to actually prove it yet, and I think we're starting to get to that point where we have the standards, the methodologies, the technologies, and the data to start actually proving on an intensity basis how much better we are. Unfortunately, most other parts of the world have not started to clearly demonstrate that yet, using the same standards and technologies, and especially using auditable approaches. I think it's only a matter of time before importers of especially LNG start to integrate some of these standards for how to go about transparently calculating methane intensity for an LNG cargo, for example, and that's when it'll be becoming, even more clear that the North American product is a lower intensity. But I've been wrong before, so only time will tell when the numbers actually emerge.
So maybe one last question. It's hard to let you go, Thomas, but we a good friend asked us this last week, look. I believe, natural gas is a good fuel. These problems are fixable. We have the technologies to do it. We're going to lean in and, quote, fix it. We'll eventually standardize everything. We'll probably settle out at a level which is, reasonable cost, because you can't compel people to do things that, I guess you could, but, so optimism around this whole thing. but how long does it take to sort itself out? Meaning, when do we get to reasonable cost, standardization, the public gets it, the industry says, okay, we're behind it. Like, how long does it take for this process to play out?
I think that what I often say is that net zero natural gas is not a technical challenge. I mean, it is a technical challenge, but it's not really one. It's more of an economic challenge. We have the technology; it exists. We need to spend the money and achieve it. And the drivers are materializing, and we're starting to see that happen. Over what time period? I wouldn't be surprised if methane from oil and gas is largely solved in the next 5 years in North America. But that's the technical emissions reduction challenge. It's not the public perception challenge. I think the public perception challenge is very different. The other thing to keep in mind is that if you want true net zero natural gas, you not only have to reduce the Scope 1 and Scope 2 emissions along the supply chain, but you also have to capture the CO2 that's combusted when that's emitted when the gas is combusted, for example, generating power, industrial processes. So, but there is no reason why we can't achieve net zero gas, and why natural gas, should continue to be a part of the energy solution. It's not a transition fuel. It should be a forever fuel. If we can, learn how to produce it sustainably, which we absolutely can.
Well, I think that last comment, that's a really good one to end on. So, Thomas, you've got yourself right in the middle of all this stuff. So congratulations, and let's stay in touch, because I know it's going to keep changing, as all these things kind of keep moving. So really appreciate your time today.
Thank you so much for the opportunity, Maynard. It was awesome to be here, and reach out anytime.
You got it. Thanks, everybody.